Welcome to today's video on joint finances and the myth of the bank relationship. To begin, we will set the stage for why starting your marriage with the right accounts matters and how banking rules have changed. In particular, we will challenge the assumption that loyalty to a big national bank yields better benefits and show you a performance-first approach that maximizes yield and minimizes fees. Next, we will walk through a practical, step-by-step system. And finally, we will end with a quick quiz and action plan. Let's get started. Here is our agenda. First, we will debunk the idea that a consumer banking relationship with a large bank yields better terms. Then, we will compare national branch reach with high-yield options. After that, we will show a winning split strategy for checking and savings, explain cash management accounts, and provide a step-by-step setup. Next, we will highlight common pitfalls, present a quick quiz, and close with a concise summary and next steps. Let's move forward. Historically, some consumers believed that opening accounts with a large bank and maintaining a relationship would unlock preferential treatment. However, for standard checking and savings today, this approach is largely obsolete. You are typically treated as an account number rather than a valued relationship. Therefore, for average consumers, big banks rarely provide better terms than online banks or credit unions. As a result, you should focus on objective factors like zero monthly fees and higher interest rates instead of brand loyalty. Let's explore why the loyalty strategy fails. First, large banks typically treat standard checking and savings customers uniformly, which means no special perks just for staying loyal. Second, average yields at traditional brick-and-mortar institutions are often significantly lower than what high-yield savings accounts offer. Third, monthly fees, minimum balance requirements, and incidental charges can gradually erode your savings. Fourth, superior rates and user-friendly features are frequently found at online banks or strong credit unions. Consequently, the best approach is to select institutions based on measurable performance. The annual percentage yield, fee structure, reliability of service, and the quality of tools such as bill pay and mobile apps. On the left, big banks emphasize physical branch convenience, but they often offer lower average interest rates, impose monthly fees or minimum balance requirements, and provide limited perks for standard customers. Innovation can be slower. On the right, digital-first options such as online banks, credit unions, or brokerage-based cash management solutions provide high accessibility through robust mobile apps, often feature top-tier yields, and commonly eliminate monthly fees. They frequently offer more advanced automation tools and iterate more quickly. Therefore, the right side tends to be more performance-oriented for everyday consumers. This flowchart illustrates a high-performance cash system. First, direct deposit lands in a free checking account used for bill pay and daily spending. Next, a scheduled transfer sweeps surplus cash into a high-yield destination, such as a high-yield savings account or a brokerage cash management account. From there, funds can either be sent back to checking for large purchases or routed into investment accounts for long-term growth. Additionally, when using an ATM, any fees incurred can be reimbursed by certain cash management accounts on a monthly basis. Finally, overdraft protection can be set up to pull from the high-yield account to the checking account, reducing the risk of overdraft charges. Branch networks matter less today due to robust digital tools. Electronic transfers between institutions are now dependable and fast, enabling you to manage funds seamlessly. Many cash management accounts offer global ATM fee reimbursements, making physical branch access less important. Therefore, you should prioritize higher yields and zero fees rather than in-person access. If you relocate, your digital-first, high-yield approach travels with you without disruption. This sequence diagram shows the life cycle of an ATM transaction. Initially, the customer uses a debit card at a global ATM. The ATM dispenses cash and applies a fee. The debit card system posts the transaction, and the cash management account records both the withdrawal and the associated fee. Subsequently, at the end of the statement period, the cash management account reimburses the ATM fee to the customer's cash balance. This mechanism effectively neutralizes ATM access costs across locations. Now let's set up your system. First, choose your high-yield hub, a high-yield savings account, or a cash management account. Second, open a free checking account that is reliable and offers strong online tools. Third, link the accounts to facilitate quick transfers. Fourth, route your direct deposit to your chosen landing account, typically checking or the cash management account. Fifth, Automate bill payments and daily spending from checking. 6th, schedule recurring transfers to move surplus cash into the high-yield account. 7th, enable overdraft protection from the high-yield account to checking. 8th, test small transfers in both directions to verify speed and reliability before moving larger amounts. This table serves as a concise checklist. For free checking, the primary goal is daily spending and bill payments, with 0 monthly fees, strong mobile functionality, and a debit card. Early direct deposit and budgeting features are beneficial extras. For high-yield savings, use it for emergency funds and reserves, focusing on top yields and no monthly fees, with optional bucket or goal features. For cash management accounts, aim for an all-in-one cash hub that provides attractive yields, bill pay, a debit card, and ATM fee refunds. Check writing and mobile check deposit are advantageous. For money market funds, look for a low expense ratio and next-day liquidity, and consider government funds if safety is paramount. A cash management account can serve as a powerful central hub. It often pays competitive interest on cash while providing checking-like utility, including bill payment, debit card access, ACH transfers, and mobile check deposit. Many providers reimburse ATM fees worldwide, reducing access costs. Depending on the provider, cash may be swept to FDIC-insured partner banks, or it may be held in or allocated to government money market funds. It is essential to review the specific coverage and structure because different providers implement these features differently. Consolidating household cash into a single hub can streamline joint financial management. This pie chart provides example ranges for cash allocation. Checking typically holds 1 month of expenses, which may equate to 10 to 20% of liquid cash depending on the household. The high-yield destination, such as a high-yield savings account or cash management account, holds the majority, roughly 80 to 90%, covering emergency reserves and near-term goals. Optionally, sinking funds can represent up to 10% and may be organized as buckets or sub-accounts within the high-yield platform for clarity. Here is a quick 2-account playbook presented in Markdown. First, checking handles daily operations with 0 fees, direct deposits, and bill payments. Second, the high-yield account, whether a high-yield savings account or a cash management account, functions as the yield engine, with scheduled transfers from checking and optional buckets for goals. The code block outlines a monthly automation cycle that starts with direct deposit, handles bills, transfers surpluses, and then refills checking to maintain roughly 1 month of expenses. A simple checklist prompts you to open accounts, link them, set automation, enable overdraft protection, and test small transfers. Quiz time. The question asks, which setup best maximizes yield while minimizing fees for newly merged finances? Option A suggests relying on a large national bank and hoping loyalty delivers benefits. Option B uses only an online checking account and ignores savings yields. Option C proposes splitting between a free checking account for spending and a high-yield savings or cash management account for reserves and goals. Option D suggests deciding based solely on branch count. You may pause the video now to consider your answer. We will discuss the correct choice in the next section. The correct answer is the split strategy, using a free checking account for daily spending and a high-yield savings account or cash management account for reserves and goals. This approach balances convenience and maximum yield while controlling fees. This mind map organizes key decision factors around selecting a cash setup. Fees include monthly charges and overdraft costs. Yield covers interest rates and fund expense ratios. Access includes ATM fee reimbursements and transfer speed. Reliability spans app uptime and the quality of customer support. Coverage addresses FDIC sweep programs, SIPC protections, and money market fund type. Finally, automation includes bill pay capabilities, scheduled transfers, and alert systems. Evaluating these categories provides a holistic comparison among providers. Let's address common pitfalls. First, overdraft fees are avoidable if you enable overdraft protection from your high-yield account to checking and set account balance alerts. Second, rather than chasing loyalty, monitor your yield and fees quarterly. Third, avoid unnecessary complexity by consolidating to one checking account and one high-yield destination. Fourth, as rates change, schedule periodic reviews to ensure you remain competitive. Fifth, when moving residences, keep the same digital-first setup and simply update your address and account links. Sixth, minimize ATM costs by choosing a cash management account that reimburses ATM fees. Finally, for joint finances, ensure both partners have appropriate access, beneficiary designations, and notifications configured. Before we conclude, here is an important disclaimer. This content is for educational purposes only. It is not legal, tax, or personalized financial advice. Banking and brokerage features, yields, fees, coverage, and policies can change, and they vary by provider. Always review official disclosures, verify current APYs, fee schedules, coverage structures, and terms, and consider consulting a qualified professional for your specific situation. To recap, prioritize performance by combining high yields with zero fees. Use a free checking account for spending and a high-yield savings or cash management account for reserves. A digital-first approach often provides superior outcomes compared to emphasizing branch count. Automate transfers and protections to ensure consistency. Finally, rate shop on a regular schedule and be willing to switch providers if better terms emerge. Thank you for watching. If you found this helpful, please like the video, share it with your partner, and subscribe for more content on building a high-performance household money system. Finally, tell us in the comments which account combination you are using and what APY you are getting today.